good evening for watching my YouTube channel. Today, guys, let's see what's going on with the market. Guys, Dino and Alibaba Cloud join force to deliver logistic data integration and management to media and the enterprise. That's the part of the news, guys. This is the bullish for Alibaba and this one. Another one, guys. We saw Facebook closed the red on and see as a meta trend as, as an appeal to AU App Store had launched. So here you see Facebook has some trouble. When you check here, this is that the other day Standard Charter upgrade the equity to core heading. Let's listen to this news, guys.
As we get, even further when it comes to the yield curve inversion, recession risks are building. It seems like more broadly as we get to this point in the tightening cycle are really elevated. So how are you balancing the way that you invest now?
So our core recession view is still intact, just that the timing of when recession will occur, we have pushed that back by about 2 quarters or so to the first half of 2024. And the key reason for that is really the very resilient economic data that we've seen coming out from the US, particularly in the consumer sector as well as among the labor markets. Because if we look at where we stand today, the manufacturing sector is certainly in a recession, but the consumer sector is still humming along very, very nicely. And I think the key driver for that is really the build-up of excess savings that we have seen during the pandemic.
Yeah, so guys, they are talking about recession, and I don't know, guys, you can have recession. I don't think it. And let's go down here. 6 hours ago, news says US aim to restrict access to cloud's computer service from Amazon. So guys, this is the bad news for Amazon, and I think guys, tech is going to be cooling off. Whenever you see some bad news like this, it's going to be make big tech company to cool down. And let's see down here again, say here how much forecast come theories take on Apple will be warned today, so I don't want to go sit there. Netflix here, guys, and AMC is closing or is open green, which is good thing, guys. And let's go and here, guys, what's going on with manufacturer layoff into play. So guys, let's hear the video.
What's the instance analysis on the numbers?
So output, which is production and employment, adjusted to the reduction in demand that we've seen now for 9 months, is definitely more in line with what the demand has been. The net result is that for the first time in quite some time, we're seeing layoffs come more into play in the month of June than we have since the pandemic recovery. So, I've been tracking the hire to force manage ratio, which is hiring and who is trying to manage their headcount down. First month that I saw a shift in the amount that layoffs were that force manage compared to freezes and attrition. So we are probably at a little bit of a transition here. I don't know if we've hit the bottom yet, but I think the fact that that output is aligned with demand is a good thing in the modern term.
Tim, what kind of timeline are we looking at here? I mean, there's still a little bit of a consensus building on Wall Street that the R word, that recession that we've been waiting for 1 to 2 years is going to hit at the end of the year. Is that a timeline that lines up with the data you're seeing?
Well, our forecast in December said that the second half of this year would be much stronger than the first half. By the time we updated that in May, that opinion had kind of diminished a bit. I do have quite a few comments indicating that they see really the downside, probably the trough here in the first quarter of next year. But I think overall the panel, we still feel late Q3, late Q4 may be the trough, but it remains to be seen. We have not hit the bottom yet. We have some really weak numbers on the input side, which is very positive, meaning that the supply base is very accommodative. I pointed out the fact that pricing took another step down, and that was really across the board, and that's a very positive thing.
Guys, for personally me about recession, guys, I don't see recession because the next earning, guys, will be.
I'm interested in what's happening, whether the second half can in any way sustain the fuel in the first half.
Well,
Caroline, what I think we're going to see is a period in which markets sit in a trading range, and perhaps we see a small pullback in the next several months. Clearly, there has been a lot of excitement in the first half of the year. There needs to be time for that tested. Having said that, though, I think by the end of the year, we'll see that the S&P 500 has finished higher.
Okay, interesting. Just to dwell on that, finished higher from where it is now, finished higher just all on out on the thriving first half of the year?
From where it is now, but modestly. What we're experiencing right now is a period of uncertainty. We've gotten so much hawkish Fed speak, although I think it's largely bluster. What the Fed needs to do, though, is keep a lid on financial conditions really easing. And so it's important that we hear that very aggressive Fed speak. It should cause some kind of pullback in markets, and that's what we need to see right now. But I think by the end of the year, it will become clear that there will be an economic recovery in the offing in 2024, and we'll see some movement upward in stocks.
So
As we get
guys, let's hear about the standard charters updating. So guys, I'm highlighting the news. So if you miss it, I'm highlighting, guys. So let's go.
even further when it comes to the yield curve inversion, recession risks are building. It seems like risks more broadly as we get to this point in the tightening cycle are really elevated. So how are you balancing the way that you invest now?
So our core recession view is still intact, just that the timing of when recession will occur, we have pushed that back by about 2 quarters or so to the first half of 2024. And the key reason for that is really being very resilient that we have seen come out from the US, particularly in the consumer sector as well as among labor markets. Because if we look at where we stand today, the manufacturing sector is certainly in a recession, but the consumer sector is still humming along very nicely. I think one key driver for that is really the build-up of excess savings that we have seen during the pandemic that have resulted in consumers and the labor market being
Audrey, we are, of course, banks to report earnings week that would start the earnings season in earnest here in the U.S. What are you factoring in terms of the next catalyst in terms of global equities as we head towards the next earnings season?
So I think next week's earnings season will be a key validation or very checkpoint for market as well as for investors. If you look at all the overall expectations that's been stacking up, analysts have been revising down the earnings estimates for Q2. So if you look at the current estimates, they're expecting is about negative 6.8%, which is one of the lowest quarterly year-on-year growth rate since the end of 2020. And given that patients has already been very much lower, yet with still economic data actually humming along quite nicely. And if you look at the economic supply index, for example, that's still firmly in the positive territory. There's some sense that in the event that earnings turn out to be better than the negative 6.8% that's been expected by this, then there's room for the equity rally or that we've seen so far to extend and continue. And if you look at from a short-term positioning perspective, no doubt we've seen a peak in sentiments, but positioning by most investors, if you look at CFTC data, investors are still quite net short, so quite happy to catch it as well.